Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. How are you, sir?
Jared, hello. How are you doing today?
Better than I deserve. Having a great day today. How are you?
I'm doing great. Just came back from a little bit of exercise to get the blood pumping. Perfect. Feeling good.
That's
Feeling
awesome.
good.
We just got back earlier this week from a little time away with the family. We got to go do a cruise, which we were a little skeptical of because
How'd that go?
The missus she's not real good on motion items, right?
Big boat or small boat?
Big boat. Big boat. It held 4,500 people, including crew. So lots of folks there. It was awesome experience, but with the missus, she's got to have that little patch that you put right behind your ear, like she needed a prescription for it, the whole nine.
No way.
And she had a great experience with it. So really, really cool. The kids loved it. All was good.
The only cruise I've been ever on was when I worked up in Alaska picking fish, and it was a little skiff. That was my cruise back to the campsite. That was enough for me.
Well, with all the fly boys we work with, you got to say cruise. Sometimes they say cruise, and it's a 9-month tour.
I know. There was a reason I went Air Force. I knew I got to be landside, and I didn't want to be in a boat for 6 months. Although, some of those stories are really great. So I'm sure I missed out on that side of things, but that's okay. There's other trade-offs.
I love it.
Yeah, gosh.
Yep. Well, so bringing us to topic for today, let's bring it back to basics a little bit. We really want to peel back, maybe some of the confusion, or I think we do a really good job of, not getting too crazy granular or too much into the weeds on some of this stuff, but it naturally gets there, right? Everybody wants to pull it apart and understand what they're working with and how they're working with it, what that all looks like, which we're all for having those conversations, but they can get bogged down when we try to talk in generalities about someone that's a specific situation, right? That's why we offer a call or an ability to speak with us, is that we will custom make whatever policy is designed for you, for your family, for your situation. Every single policy is different. There's not one that we make that says, well, here's the cookie cutter for someone that's done XYZ. Like that's just not what it's there for. This is custom built per person. Right. So I think it's tough when we want to talk generalities, but at the same time, everything is custom made and custom built. So I just thought we could bring it back to basics and talk some of the, there's 4 components really that are key. Base policy, or the base of the insurance policy, the PUA, dividends we just talked about, and then how that drives cash value. So maybe we could just talk base and PUA.
Sure. Yeah, base is, as we know, is the chassis upon which you build the whole thing, and a lot of attention is put on PUA, as it should be, but a lot of people don't spend the time understanding how important that base portion is, because it drives a lot of very important decisions later on. Yes. The base is the engine of the core contract that allows you to build with the PUA. And you touched on PUA, and my gosh, there is literally an infinite way you can apply PUAs. It's not, and PUA, for those that aren't familiar with it, it's paid-up additions. There's level paid-up additions. There's fixed paid-up additions. There's SPO, which is a single premium paid-up addition. There's a blended rider which gets into a whole nother stuff. And then you can do combinations and permutations of all these. I had a guy call me a while back, competitor, but I'm an open book, as are you. I've got nothing to hide from anybody. If you're out there and you're in this business and you got a question, call Jared, call me. Always happy to share what I know. But this particular individual wanted to know how I built this stuff, and he wanted to do it too. I said, well, okay, the best thing to do is to read the book, Becoming Your Own Banker, and get into the program and become a practitioner. That's the best way to be truly proficient at this stuff. But I shared some things with him, and lo and behold, he peels off and took some of the information that I gave him. And next thing I know, he's out there building these contracts. I'm like, Okay, but you're doing a disservice to your customer
Yep.
if you're not looking at all these multiple avenues you can take this down and, as you said, design it for that customer. It's that important to ask the
Yes.
right questions, know what their priorities are, and how you can build for them. Is it the front end, the middle end, the back end? They have kids, they have family, they're single, they want to build a business. Do they have debt? Do we have to do a debt rotation? There's 100 questions you can ask.
Yes.
So
Yep.
talk
No,
about
I
your own
love that.
experiences. Yeah.
No, I love that. And I think one of the common questions that show up, especially when you talk about base, right? The base is the chassis that we're talking about. That's a common kickback that I receive on that is that it's too expensive. And it's too much money that goes into that. So, where you end up down is kind of a discussion on, you know, the comparison of base policy in terms of a term policy versus a whole life policy, right?
Right.
If you buy a 30-year term, I don't care what the coverage is. If you're going to pay, let's say $100 a month for term coverage, for that same coverage in a whole policy, you might pay more like $1,000 a month. Like it's not even close in the comparison, right?
Right.
But they are not the same product, right? What we
No,
just
very
said
different.
here was a term, which is a 30-year term, at which point there's nothing to show for it. You have nothing that you've created at that point. Whereas
Right.
when you're dealing with a whole life product, you're buying a death benefit that will at some point guaranteed to pay. Now, where that gets a little fuzzy is that you may end up paying for that over the course of 35, 45 years, depending how you structure it. This is where you get into that nitty gritty, right? But
Right.
at the end of the paying for that whole life policy, you are
Right.
guaranteed to have something. Now, that something may be cash value, that something may be death benefit, but it's so hard to get down that conversation of the comparison of a whole policy and a term policy when they're not even close to the same product. So
No.
I guess I try to steer that conversation when someone says, well, it's too expensive. Well, they're two different products. So if you want to compare apples to apples, let's do our best to, let's buy you a 65-year term policy. What would that cost? Well, that 65-year term policy may be more like $1,000 a month, right? It's
Yeah.
just the risk that you're
And
passing
it
to
ends at
this guy,
65.
and it ends at 65, right? So, you
Yes.
know, it's all in how you think, right? That's what Nelson would say. And when you look at
Yes.
these from the option of what they are, it's very difficult to compare a whole product with a term product. But that shows up as a very rudimentary discussion that you need to understand that difference when we're talking about the difference between a base policy for a whole life product and what your term product would look like.
Yeah, entirely right. I mean, term isn't even in the same ballpark. You
Yep.
use term when you build these things, which goes back to the base, by the way, Jared. The importance of the base can't be understated. A lot of people want to build these really fat PUA policies with minimal base so they can dump all this cash in. Remember, the base is the component to keep you from making a contract. The bigger
Sure.
the base, the further out you get away from making a contract. So
Yep.
it does make a lot of sense to take a hard look at that. And if
Yes.
you have riders in the policy to allow you to add more insurance later on as your opportunities grow, pay attention to that. You could have a
Yep.
contract where I've built them before, where I'll do a sizable base and not as much PUA, but then because the person wanted to do a lot more, but they couldn't do it at that time, and so we'd overkill the term component, and then
Yep.
within a few years they would convert the term, which is fully convertible with the companies that we use. And then now that they're in the money with their job or whatever they're working on, they can expand this bucket for themselves. And it's
Yep.
very effective. So again, that goes back to the conversation. You have to know your customer. You have to know what their priorities are.
That's right.
Um, I talk a lot when we do this, but I really do my best to keep my mouth more closed than open and listen to the customer because they're going to tell
Very
you
important.
what they need, not what you think they need.
That's
So important.
spot on. Spot on. Very, very important. Well said. The other, as we kind of walk this line between the discussion of base and PUA, the other important part to discuss about base is that is the part that the insurance company knows you are responsible for until that hits its paid up part.
Right.
You may have a policy that's paid up at 65, maybe 75, maybe 95. Those are all the age at which your contract becomes paid up. But they're expecting that base policy to be paid for that entire durations.
Right.
PUAs is a little different. I know we're going to talk more about PUA, but the PUA portion is not required in the payment that you do, whether it's a monthly, semi-annual, annually, whatever you do, the PUA becomes the flexibility portion of it.
Right.
So if you set up a contract where you're expected to pay $500 a month in base, they expect that you're going to pay that until it's paid up. And
Right.
so because they're banking on your ability to do that, they make certain investments accordingly. So the longer you stay with the company, the longer they reward or the higher that they reward your loyalty to the company, to the policy that you have.
Right.
So if you're going to do 500 a month base and 500 a month PUA, at any point in the conversation, you could say, I'm done with that 500 a month PUA. I'm only going to pay the base. Okay. You still keep the policy active. They continue to pay you dividends. Everything's working out fine. And then maybe further down the road, you say, I'm ready to get back in on that PUA rider. There's a little discussion that needs to happen. You can't have let it lapse, or you can't, talk to your practitioner. But you get the idea here where, if you're looking at it from a investment standpoint of how the
Right.
insurance company is expecting the money that will be there, they can't bank on your PUAs being there, but they can bank on your base policy being there. And so they reward that accordingly. There's a different payout, so to speak, for
Right.
what the dividends look at, whether you've given your premiums in the form of base or whether it's in PUAs. So I say that also to say that some folks want to build a real skinny base and a real heavy PUA portion. Great for your cash value up front, but not great for your long-term dividend.
Right.
So what does that look like for you as a person, as your family? What does that look like? If you're okay with that, hey, well, we'll talk more about it. But that's where it becomes so customizable and so unique to the situation that each person's going through.
Yeah, and then you bring up an excellent point. Those dividends, as they're applied to the base and to the PUA, could be different. You are going to get a solid dividend with the companies that we use on the base and on the PUA, but there are companies out there that don't do that.
Yep.
And the flexibility that it gives you, and it varies by company, it varies by product, so that's a whole discussion that has to be had. But the difference between all these different PUAs are um, the flexibility built within them. Some
Yep.
companies will take an average of 7 years and they'll use that on an ongoing basis of how much
Sure.
you've paid in the PUA, and they can reduce your PUAs going forward. Other companies will give you three strikes and you're out. If you don't pay it for 3 years. In any case, most of the companies require at least a minimum monthly payment or annual total to keep that rider in force. If you let that
Yep.
rider slip, it's gone, and that's a shame because it
Yep.
doesn't cost much. And then there's a look back period. There's so many different options to look at, and that's a conversation that you really need to have with the practitioner to make sure you're getting exactly what you need and what you can fund correctly.
That's right. So, maybe to again go back to the basics, like we've said, there has to be a chassis, there has to be a base whole life product. That's the starting point. Then you get to determine how much you'd like to add in terms of PUAs. And there's going to be a base policy and a PUA policy, but we work on what that looks like. We work with the individual to build
Yes.
that custom made for them, but we work in an environment where we want you to understand both of those pots that you're contributing to and how you're building what you're building, because at the end of the day, infinite banking concepts is all about your need for capital while you're alive. Now, yes, we're going to build a great product for that you're able to turn a legacy changing life amount of money to your
Right.
heirs.
Right.
But if you solve your need for finance while you're alive, your death benefit will be more than you've ever thought possible.
That's right.
So, so the goal is, yes,
Right.
we want to build you a base and a PUA combination that allows you to finance to build your need for finance while you're
Right.
alive. So the living benefits of these policies is really what we're after. Am I saying that correctly? Would you agree with that?
No, no, 100% correct. Yeah. Saying what you just said is almost word for word what Nelson told me way back in the day. I mean, honestly, it's that close because as you're building this policy and using the cash values to run the things of life,
Yep.
that you get a step up basis every single year. Like, it's
Yep.
guaranteed. You're going to get a step up basis. And when you throw the dividend into it, holy cow, it becomes tremendous. And you're going to see more death benefit available on the back end of that contract than you ever thought possible. And by the way, more than you would have ever gotten approval for with a life insurance company based on your lifetime economic value. It's just this thing as an engine.
Yes.
But we don't really care so much about the death benefit. Yeah, it's nice. Somebody else will enjoy it besides you and I when the time comes.
Well
But
said.
while we're living, man, oh man, I can get so much done. It's cool. It's
Yes.
great. It's awesome.
Yes.
So,
So I think that helps us differentiate between the base and the PUA because, like we said, we're just getting back to basics, right? I think we've done a pretty decent job hitting the base. That's your
yeah.
chassis for your product. It is you are paying a premium for that base policy that is attached to a death benefit.
Yes.
That amount will grow will develop a cash value. Now, the base policy requires a little bit longer to build a cash value. That doesn't carry as high of a cash value, which is why we said earlier, if you're heavy on the PUAs up front, you're going to see a little bit more cash value.
Right.
As opposed to if you're a little more heavy on the base,
Right.
it's going to take you a little bit longer to see that cash value. So it's customizable to what each individual needs.
And
So
yeah.
yeah, go ahead.
I was going to say, and just make sure for those out there, if somebody drops one of these illustrations in front of you, make sure that that PUA is properly funded for the duration of the contract. I can't tell you how many times I've seen it where they'll take it up for 12 or 15 years, and then beyond that, it's going to mech. And so they simply don't fund it there, and they present you with a contract that looks great, but it's going to mech down the road. So always, always, when you're ready to buy something and you have, it's not a good idea to be doing illustrations back and forth up front. But when you get to the point of where you're going to close the deal, you're going to buy a contract, make sure you're looking at an illustration which shows the entire duration of that PUA, that it will not mech. It's
Yep.
so important
Yep.
because remember the
Yep.
difference, and you touched on this, the difference between the base and all the PUAs is, as far as the insurance goes, is identical.
Yep.
Base insurance and PUA insurance is the identical product. But as you
Yep.
said, one is you must perform on that one for premium, and the other one is an option.
Right. And just like you were saying with, a base policy, you're going to pay on that for quite some time. The
Right.
expectation is, it may be 10, it may be 25, it may be 45, whatever the duration is, that's flexible. But you're going to be paying that base period for a long period of time, or the base premium for a longer period of time. Whereas the PUA, just to break that down a little bit, that's a paid up additions, which I kind of view that as a one
Fully
pay
paid for.
policy. Right,
Yeah.
you fully pay that when you when you
That's
hand
right.
over the premium for that PUA. That's the same exact policy that you've got set up, but it's a single pay. It's a one pay,
For that
one
year.
year annual pay for that. So whatever your death benefit is that will provide as you pay premium in the form of PUA, it's going to increase your death benefit, but it's also going to increase your cash value.
Right.
So just kind of delineating between the two of those, right? Between the base policy,
Excellent.
between the PUAs, both really and really important parts of the way you set up your policy, your contract, yet a small difference between the two.
One thing you said, which is important, among the many things that you've said that are important, is you commit to paying for this thing for a long time. What if somebody is, 60 years old, said, I don't want to pay for this thing for, umpteen years? Well, guess what? They're a perfect candidate for a 10 pay. And you can
Yep.
structure a 10 pay for where you pay it for less. If you do a dump in on the front end, meaning you're paying single premium paid up additions, there's enough cash in that contract where it's going to kick out a dividend, which will bring down your premium because you can pay it from the dividend if you need to. There's
Yep.
all kinds of
So
solutions
many
out there.
options.
Yeah, so don't let the time horizon dissuade you from looking at a infinite banking structured contract because we can make them work regardless of your status in life. Where you're young, middle-aged, or seasoned, you can make this work.
Well, and once you can get through business setup, right? And I say
Right.
business setup, I go back to the grocery store example from the book
Right.
where, you have to turn over the peas on those shelf multiple times before you
Right.
begin to make a profit, right?
Right.
And so you have to do that when you set these up. There's an upfront cost that you're taking on. There's a setup cost that's just installed naturally into what you're building. So, but once you get over that hurdle, once you've turned over the peas on the shelf enough to start seeing some profit from your product,
Yes.
you are unlocking really something that's an amazing feature because whether you're 10 years, 20 years, whenever this happens, you have the option to just as you said, maybe you turn the dividends from funding PUAs, maybe use the dividends to fund your base premiums.
Yeah.
That's an option, but you can't do that in
100%.
year two,
No.
right?
100.
No. So
No.
yep. So that's one option. And something else that's not going to show up in like a term product, you could switch to a reduced paid up. You can say, I know I was going to pay till 65. I want to stop at 58, and we're going to just call that contract paid up here at 58. Well, now the death benefit that was supposed to be at 65 will be much less, but you've already paid enough into it to have it paid up at 58.
Yes.
That's not an option with a term product. You can't get 20 years into your 30-year term and go, hey, I just want to have a reduced paid up. That's not an option.
Right.
So there's all kinds of options, just to name a few, that you have with custom built product that's really flexible.
Yeah. It's all a matter of understanding what you're getting into and having a clear pathway of why you're doing it, what your objectives are and how you're going to
Yep.
get there. And
Yep.
if you do all that, you're going to be just fine. You're going to be just fine.
And I think the other thing that differentiates the practitioner community from others is, when you sign up for a whole life policy with John or myself, that's what it is. It's a whole life. It's a long-term relationship. We're going to show up at the minimum annually to make sure you understand what's going on, how your product is being used, what you're doing with it. Do you have questions? Because the absolute first and best case scenario when you're about to make a big change is just to have a conversation. Just be honest with lost my job. I had this happen. This is where I'm looking. Okay, well, you've got this flexibility down this avenue. Or had a family member pass away, left a huge inheritance, unsure what to do with it. Well, you've got options here. You've created this ability to
Yes.
increase the size of your policy. All of the
100%.
and everything in between, right? So just having a conversation with someone like you or I that's doing this every day, it just accentuates what you've got for options.
Agree 100%, Jared.
Yeah.
So, well, our next podcast, we should go into some of the writers. We can have a discussion on that to share because those get a little bit
Sure.
fuzzy for people, and oftentimes those writers play right off of these paid up editions and why you do them and the benefits of packing those into a contract
Yep.
for current use or future use. It's
Sure.
more flexibility. But
Yep.
everything comes at a cost. I mean, every part of this contract has a cost benefit relationship, and that's why it's so important to look at what the objectives of each client are and what they want out of it so you can avoid building in things that are not necessary or conversely adding things that are fundamentally important that maybe they're not
Yep.
thinking of.
Yep.
So, but
I
this
think
was just
someone said, well, and I stole this from somebody else. There's no free lunch in insurance. The actuarial science knows the expected cost over the average of all of the human beings that are out there. They have the science down pretty quick, right? So
yes.
there's always a cost, right? Is it something that makes sense for you and your family, or is it something that doesn't?
But in following on that line of
Yep.
thinking,
Yep.
how you spend that money and the reward you get for spending that money is clearly defined inside of an insurance contract.
Oh yeah.
What is the rate of return? Not that you don't do this for a rate of return, but you own a
Yep.
contract and you got $1 million death benefit, and you pay into that thing for 3 years, and God forbid something happens to you. What is that rate of return? I think you just beat every option contract on the plate
That's
uh,
right.
at the brokerage house. I don't want to win that one.
I
To
don't.
be
I
clear,
don't.
to be
Yep.
clear. But I also know that what happened to the crypto market this past week collapsed, right? We were at 120,000 and it was down in the low 80s, I think. I don't care about that, but I'm just pointing that out because our contracts went up in value every single day. Not a lot, but they go up every single day. I don't have to, I can sleep at night and I can use the money when I need to go pay for another expense.
And when you've got control over your capital.
Absolute control. It's a wonderful thing. It's a wonderful thing. So I think we hit the high points. Anything else we missed there, Jared?
No, I think that's good. Always willing to hear critiques and hear feedback on how we could do better or what we've done that we can, improve on. Wide open on that. Reach out, let us know.
We'd love to. We get questions from people all the time. We'd love to hear yours. Please reach out to Jared, reach out to John. We're always happy to hear that. We're at flightpathfinancial.com. And our phone numbers are there as well. So if you want to talk to us on the phone, we actually answer our phones. You won't get a menu of 56 options in some foreign country. We don't do that.
Love it. Love it.
Yeah.
Awesome.
All right, Jared. Well, let's sign off for today. It was wonderful talking with you, and we will catch up for the next one soon on let's talk about riders next time.
You got it. Have a great day. Happy Thanksgiving.
Happy Thanksgiving to you too, Jared. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.